Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CleanSpark.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. CleanSpark, it presents one of the most compelling yet complicated narratives in the digital asset space right now.
Complicated how?
At its core, this is a story about a company going through a really aggressive high-stakes transformation. They're just scaling ruthlessly.
To position themselves for market dominance,
Right.
As a focused pure-play miner.
Exactly. It sounds like a textbook growth stock, but the data, it suggests this massive internal tension.
It's that classic puzzle, isn't it? You see this huge growth now, but it's coming at the expense of profitability in the near term.
Right. And we have to figure out if that pain is strategic or if it's something more structural.
Okay. So we're looking at a management team that basically believes the only way to win is to be the biggest and the most efficient.
Yes, especially in this post-halving environment that hit the sector earlier this year. Their thesis is simple.
Survive the squeeze.
Survive the squeeze by achieving, insurmountable scale.
Okay, so let's unpack that scale first, because the top line numbers are, well, they're truly astounding.
The growth momentum is transformative. I mean, when we look at their full fiscal year 2025 revenue projections,
Yeah.
they're hitting $766.3 million.
Okay.
That figure alone represents a 102% year-over-year increase.
102%. I mean, think about that. You're doubling your revenue in 12 months. That's not just growth.
No, it's a total re-architecture of the company's size and its footing in the market. It means they're successfully deploying capital into equipment and facilities that are coming online and generating revenue almost immediately.
And it's not just a one-time flash, is it?
Not at all. The sustained momentum is visible quarter over quarter. In Q2 of fiscal 25, they reported $181.7 million in revenue.
Right.
That's up 62.5% from the same period the year prior. It just shows consistent execution on their build-out strategy.
So for you listening, if you're newer to the mining space, speed and size are only two parts of the equation. The third, and you could argue the most critical part, is efficiency. So what's their competitive moat when it comes to the actual operations?
It's cost leadership, plain and simple.
Yeah.
Management has explicitly said they are driving to have one of the most efficient cost structures in the entire industry.
Which is everything in this environment.
It's mandatory for survival. In an environment where the Bitcoin halving event just slashed the revenue miners earn per block by 50%, cost control is no longer a luxury.
That halving context is so crucial. The entire economics of the business just changed overnight. If you don't aggressively scale or dramatically improve your efficiency, poof.
Your margins just evaporated.
Go down.
And CleanSpark's strategy is to push both of those levers at the same time.
Okay.
They're optimizing their fleet for lower power consumption while also benefiting from the economies of scale that, come with these massive operations.
Do the numbers back that up? Does it confirm that operational discipline?
They do. Just look at their Q2 performance. They produced 1,957 Bitcoins.
Wow.
Yeah, and their average revenue per coin was reported at $92,811.
So that really demonstrates that they are harvesting coins effectively and efficiently.
It does. And this operational discipline creates a defensible barrier against the smaller players who just can't absorb the high fixed costs or get access to those cheap power contracts.
I also found their commitment to being a pure play miner really interesting.
Right.
In a market where so many competitors are trying to diversify, into AI or cloud services, CleanSpark is just leaning hard into one thing, pure Bitcoin exposure.
And that strategic clarity is vital, especially for the large institutions they are trying to attract. If you want direct high-leverage exposure to Bitcoin mining.
Without the complexity of energy trading or some side venture.
Exactly. CleanSpark offers that clean exposure. It reduces that conglomerate discount that you see so often.
Okay, so we've established the bullish case. You've got enormous growth, a clear strategy, and top-tier efficiency. But this is where we hit the core conflict.
The profitability puzzle.
Your profitability puzzle. How can a company growing revenue by over 100% swing to a net loss?
This is where we shift from a growth story to a capital deployment story. And it's a tough headline for any investor to swallow.
So what's the number?
In Q2 of fiscal 25, the company posted a sharp reversal, a net loss of $138.8 million,
Oof.
which translated to a loss of 49 cents per basic share.
That's a significant amount of red ink, especially when you compare it to the prior year when they were showing net income.
And the adjusted EBITDA, a key metric we all watch for operational cash flow, that also tanked. It dropped to a negative $57.8 million.
So if you just read those two lines from the report, you'd assume the business model is failing.
You would, but the context, it sort of reframes that failure as a strategic investment. This massive compression in profitability is almost certainly a direct and temporary consequence of their extremely aggressive capital expenditure.
Right, the CapEx.
Remember, they were rushing toward a staggering operational goal,
Sure.
achieving 50 exahash per second. That's EHHs of hash rate by June 2025.
Can you just clarify that metric for us? What exactly is an exahash per second?
Sure. Think of hash rate as the measure of processing power. It's how quickly the network can process transactions and find new blocks.
Like horsepower in a car?
A great analogy. It's about brute computational strength. Exahash is 1 quintillion calculations per second.
1 quintillion.
So reaching 50 EHs means they are building, wiring, and commissioning infrastructure at a breakneck speed. They're absorbing all the immediate costs now.
Like buying the ASIC mining rigs, building the facilities.
I love it. Long before that equipment is running at full utilization and actually generating peak revenue.
So the loss we're seeing is really just a result of timing. They spent the money now to buy the assets, but they won't see the full revenue benefit for another few quarters.
Precisely. That creates this temporary negative earnings gap. They're deliberately sacrificing current profitability to secure future market dominance.
Which, for long-term investors, creates a turnaround opportunity.
Exactly. The loss is an engineered transient state. It's necessary to jump to that next category of scale. Once that 50 EHs comes online, the profitability should snap back, and dramatically.
Because the revenue stream will be multiplied across a fixed, now fully paid-for operational base.
You got it.
But that brings us right to the risk. The market hates uncertainty. If they fail to execute this build-out on time, the market won't just see a temporary loss.
No, it'll see a management team that overpromised and underdelivered.
While burning through a mountain of capital.
That is the hinge point. But to mitigate that execution risk, they've had to build a formidable financial war chest.
And that's where we move to the balance sheet. Because despite all this heavy spending, they have substantial hard assets and liquidity.
Let's start with the most obvious hedge they hold.
Their Bitcoin treasury.
Their Bitcoin treasury. As of the end of March 2025, they were holding nearly $980 million in Bitcoin.
Wow. $979.6 million, to be precise.
And this treasury serves two key purposes. First, it's a massive hard asset floor for investors. It gives you a built-in measure of downside protection.
It means the company is always sitting on significant liquid wealth no matter what.
Right. Plus, they kept $97 million in cash and maintained working capital of over $838 million.
So they aren't scrambling for day-to-day liquidity while they finish this expansion.
Their liquidity is sound. But the real masterstroke, in my opinion, was the capital raise they did in November 2025. The pricing of $1.15 billion in convertible senior notes.
This is where the financial engineering gets really fascinating.
It is. This raise gave them a massive influx of cash, $1.5 billion in dry powder, to fund that 50 EHs target.
But what's so special about the structure of those notes?
It's twofold. First, they are zero coupon notes, due in 2032.
Zero coupon meaning?
Meaning the company has absolutely no cash interest burden for 7 years. That's a highly accretive structure because they can deploy all $1.15 billion into revenue-generating assets without the constant drag of servicing debt payments.
That's incredibly flexible. But the second part, the convertible aspect, that's where the trade-off is, isn't it?
It is.
They avoided paying interest now, but aren't they just trading current interest payments for potential future shareholder dilution?
That's the critical high-stakes trade-off you have to understand.
Right.
The convertible notes allow the bondholders to convert their debt into company equity into shares if the stock price hits a certain threshold.
So if CleanSpark pulls this off, the plan works, the stock price soars, then those bondholders will convert.
And that leads to significant dilution of existing shareholders. The company essentially made a bet.
A bet on themselves.
Exactly. They said, we are so confident that we will execute this growth strategy, that we will accept the risk of dilution down the road in exchange for zero-cost capital right now when we need it most.
It's a high-confidence financing move, and they managed it without dilutive common stock raises, which would have just crushed the stock price immediately.
It signals serious institutional confidence, and that's backed up by their overall conservative balance sheet. Their debt-to-equity ratio is only around 0.34x.
Which is remarkably low given the magnitude of this expansion.
And don't forget the third-party validation when they expanded their revolving credit facility with Coinbase.
Good point. Lenders don't increase your credit line unless they believe in your operational credibility and your long-term viability.
Absolutely. So the money is secured, the strategy is defined, and the balance sheet is surprisingly strong.
Okay, let's pivot. Let's look forward at the structural advantages they're building beyond just raw processing power. One of the most stabilizing factors is their power sourcing, right?
Yes, their contracted power growth is a major structural moat. They reported a 43% growth in contracted power capacity.
Then why does that matter so much?
Because contracted power provides multi-year revenue visibility, and critically, it protects their cost structure from the extreme volatility of the spot energy market.
In the mining business, energy is your single biggest input cost. If that cost spikes, your profitability vanishes overnight.
It does. Securing long-term contracted power effectively locks in their operational input cost. It smooths out their margins and gives them predictability.
It's a core competitive advantage that makes their efficiency durable, not just a temporary fluke.
And all of this infrastructure is built to support that 50 EH's hash rate target. Achieving that milestone isn't just about a number, it fundamentally re-ranks them as an industry behemoth.
So, given all of this strategic planning, what are the primary risks that could still derail this ambitious push over the next year?
I'd group them into two main categories. The first is just market risk. Bitcoin price volatility.
Of course.
And although they have that billion-dollar Bitcoin treasury to mitigate the worst of a sudden crash, a sustained crypto winter would still compress their per-coin economics. It would make that profitability inflection point harder to reach.
And the second risk, which we keep coming back to, is the execution risk.
The execution risk on that massive capital deployment. They have $1.15 billion to deploy, and every step facility build-out, equipment delivery, regulatory hookups, it all has to happen on time.
If that 50 EH's target slips, that temporary loss becomes prolonged.
And the market will lose patience and punish the stock price severely.
So this is where the rubber meets the road. What are the key near-term catalysts that we all must monitor over the next 3 to 6 months to confirm this bullish thesis is actually playing out?
There are two critical confirmations we're waiting for. The first is the operational milestone, the confirmation that they have successfully achieved that 50 EH's target.
When do we expect to see that?
We should hear confirmation of that major capacity breakout by the end of December 2025. This proves management can hit its own guidance.
And the second catalyst is the financial confirmation that follows that.
Yes, the Q3 fiscal 25 earnings report. That will likely drop around January or February 2026. This is the moment of truth.
What do we need to see in that report?
We must see the expected profitability inflection. Specifically, adjusted EBITDA returning to positive territory. That shift, that transition from being a capital-burning growth story to a profitable, cash-generating scale player, that's the primary driver for massive upside potential.
So the narrative is crystal clear. CleanSpark has secured the capital, they've defined the strategy, and they've accepted the near-term pain of expansion.
Yes.
The entire opportunity really hinges on whether the market will reprice the company once the benefits of that massive infrastructure investment are fully realized.
The heavy lifting of the financing is done. Now, it's purely an operational execution game. And for you, the listener, the single most important metric to monitor over the next few months isn't the stock price.
It's the confirmation of that operational milestone.
Exactly. Watch that hash rate capacity because that confirms the future cash flows.
CleanSpark is in the middle of a strategic swing trade, heading toward a profitability inflection point. Monitor those operational metrics closely. Thank you for joining us for this analysis.
Make sure you subscribe, like, and comment to stay current with all our insights here on Smart Wealth with Joshua.